Hey everybody, welcome to the podcast on this Memorial Day weekend. Hope you have a great 3-day weekend. Today is a Saturday afternoon, and just going to go through a couple of things from a bird's eye view today. Of course, the stock market had 2 or 3 days here where it's kind of pulled back a little bit, but for the most part, these pullbacks have lasted, hours, if that. Most of the gap downs in the morning have been bought, and the stock market seems to want to continue to go higher. Now, on the screen here, I do have a couple of arrows where I think we could find support. I mean, obviously, first, we have some different moving averages in here. And I would like to see the stock market, the S&P 500, pull back to the 1600 area, which is this lower line here. And the reason why is because that was the old breakout. And to come back to it, that would be right about the point where the 50-day moving average would be, and also the old breakout. So I think that's a logical place. But again, the stock market hasn't pulled back. If it did that, that would be one of the bigger pullbacks it has had throughout this run for most of 2013, and it would kind of break this uptrend a little bit. Now, we did break it here in late April, so I suppose it could come back down again into this general area. We don't want to get too technical there, but for the most part, it's been inside this little channel for all of 2013. Now, a lot was made the other day regarding the new high. We made a new high right here, and then we reversed and finished down about 1% on the day, and that's not a real common occurrence, but it's happened before. And a lot of people were worried that was the top and that we were just going to fall back down. And I don't think that's the case. But I did point out in a blog, I guess a week or two ago, regarding how far the stock market is above these various moving averages. So don't forget. And again, you can look at this. These might look a little different than yours. Some people use simple moving averages. Some people use exponential moving averages. But here's the 200-day moving average. Here's the 100-day, the 50, and the 20. And what we want to see, obviously, is all these things are going up, so that's good. But we also want to see how far the stock market is above those moving averages. The distance between here and here and here and this one. We want to see how far they are. And what we do is look back over history to see, is it too stretched, like a rubber band? Is it going to come back in? And I'd pointed out, I don't know if it was last week or maybe the prior week, but we had pointed out that and this is just some stats of me doing a little bit of research, but when you go back and look at the S&P, at least over the last couple of years, the highest the S&P generally gets above its 50-day moving average is about 5%. So here we are at this 50-day moving average, which as of right now is on the 1592. And we at one point were about 5% above that. We're now at 3%, so we've pulled back a little bit. And now that we are working off the excess, so to speak, and again, this is very, very minor. The stock market has barely moved to the downside overall. But if it were to continue to pull back, what would be a logical place? Well, you can see that the last couple times it's bounced off of the 50-day. But there was a period of time back in last year, twice, where the stock market went below its 50-day moving average by about 2%. So again, if it did that, you'd be looking at something around right in here, around the 1550 level, which is coincidentally right at the 100-day moving average. All of these levels I'm giving you, you notice, aren't very big. We're not calling for a market to go down to 1400 right now. I think a sell-off will still be met with demand. And so, again, what we're looking for are good entry points, not necessarily what are the exit points. And if you're wanting to get cash invested and those entry points aren't coming, then again, you have to average in over time depending on what you're trying to accomplish. So we did get overbought, extremely overbought, and we're starting to work it off. And the stock market's not really falling that fast, but it is working its way down a little bit. And if it can just move sideways, of course, these moving averages would get closer because of time. So I wanted to update you on that. As far as the 200-day moving average, which is the red line here, what's normal, I guess? Well, in the past couple of years, somewhere between 10 and 12% above this 200-day moving average is normal before you get some type of pullback. We got up to about 12%, which is what we got to, by the way, in early 2011. And you know what happened in 2011? We had a really nasty summer sell-off. Well, the stock market actually went 12% below the S&P 500. I don't think that's going to happen this time. In fact, I think what we could see, if we were lucky, is it to get back to the 200-day moving average. But again, from this point, that's 150 points down now. So you're talking about an 8% decline. I don't think that's going to happen. I think somewhere in these, let's call it around the 50-day moving average, somewhere in the 1500s, high 1500s, would be still a gift. And I think, again, the stock market right now is very, very strong. You're seeing when it sells off, it's just rotating from one area to another. The days that you're seeing treasuries rally because there's fear, it tends to reverse as the day goes on and money comes back into the stock market. And so, again, overall, we're looking to buy dips still, not to sell rallies. And that's just because of what's going on. That's not because of the deficit or nuclear threats. All those things would keep you out of the market. What we're just monitoring is what are investors doing with their capital. And right now, investors are buying the dips. And that primarily is the big money. The individual investor, I think, is still sitting on the sidelines. I think there are a lot of people that are still sitting on the sidelines from way back in 2008. And I think now that we are back to kind of where we were then, I think you're going to see that some of that money that said that it would never come back in the market because they were done with the stock market after being burned in 2000 and then burned in 2008, they are going to come back in. And they'll come back in as prices continue higher. So that's a whole amount of money still left to flow in there. And by the way, when you hear about the bond market right now, there's still 4 times as much money going into the bond market as there is the stock market. So there's still a lot of conversion that has to take place from the bond market to the stock market. It hasn't really started yet. So this market can go a lot higher. We've talked about that, if you look at long term, these stock markets they tend to last about 3.5 years as far as bull markets. However, if you look at them after 30% declines, they tend to go on a lot longer than 3 years. And so as far as how much this has gone up and how long it has gone up, actually we're kind of below average. The average since about 1900 has been about 300%, and it's been about 7 years. So again, and this is based on the Dow going down about 30%, a decline of more than 30%. What was the snapback rally? How long did that last? And right now, we're just going over 4 years and up a little over 110, 120%. So again, because we had such a major decline, the snapback could be much more, severe and strong than people first believed. And so this isn't a typical bull market that lasts 3.5 years. It could last a lot longer because it's, again, going back to the old rubber band analogy, it got so stretched to the downside. A lot of what has happened the last 3 years was just recovering what was lost. Now, some people believe we're starting a new, fresh bull market from this day forward. We'll see. We have to play it by ear and basically look at what the investors are doing. And right now, they are still not showing any signs of getting tired. In other words, they're just as convinced that stocks are going up at 1,600 as they were at 1,500 and 1,400. And you would expect things to be kind of petering out, and they're not. They're actually very, very strong right now when we look at the internals of the market. But you still have to play these time frames and look for levels you're going to buy, strategies you're going to implement. I definitely would not abandon sell strategies. I definitely would not abandon income and so forth. So that's just a general view in the market. It's a little overbought. I would like to see it pull back somewhere in the, let's call it 1,600 to 1,625 range on the S&P. Again, that'd be another % or two. That would not be a big pullback, but that's all you've been getting. So we have to kind of look at history until that trend is broken a little bit. Now let's go through a couple of other things. The Dow Jones, you can see that, again, kind of bouncing, somewhere between the 20 and 50-day moving average, which would put it right around 15,000. That'd be a 2% drop. I could see it doing that pretty easily. The Russell 2000, we had shown this prior, breaking out. and you can see it's trying to bounce off of the 20-day moving average. If it came all the way back down to the 50, you're looking at a 950, which would be about a 5% pullback from the high. That would be healthy as well. But you are seeing more money go into kind of the cyclicals right now, which is another kind of healthy sign. If we look at the U.S. dollar, of course, the dollar had a nice, strong early part of the year, been languishing around here, and then of course the latter part of this month has been pretty strong as the yen continues to fall. If we look at oil, we're in this little channel, and of course we had broke down in early April, which we thought we might. It snapped right back, went to the old highs, and now if we can break above there, you might see oil finally pierce the $100 mark and go off to the races. Let's talk about gold for a minute. A lot of people believe that this is a double bottom for gold, and so you have this and this working for you, and it has held so far. But here's the thing, just like the stock market has been going up and the moving averages are going up, look what's happening to the moving averages on gold. They're all pointing down. So if you believe that gold is bottoming, it's still, over time, and I'll erase some of these arrows and draw this for you, but over time what you would expect is gold to bounce, do this, do this, do this, and then finally turn up, and the moving averages kind of start working their way back up again. Gold is not going to just turn around and shoot back up. So what you're hoping for, if you're somebody that's trading gold right now, is this first spot would be the trade, and then maybe it meets this moving average and then rolls over at some point. That's the trade. The trade isn't that it's going to go back to where it was. That's going to take a long time, I believe, or at least a reasonable amount of time. I think it's analogous to Apple. If you notice what's happening with Apple right now, is that it's going up on down days. Yesterday the market was pretty weak. Apple had a decent day, up about $3. But what's happening now is I think people are moving on to something else, right? It was the thing to short. It was fun. People could come on TV and say they were short the biggest and best company in the world, and now Apple's hated, right? But what's happening is the moving averages are not going down anymore. They're starting to go sideways. So instead of this green line is the 20-day moving average, and the blue line is the 50. You notice how they're moving sideways now. That's what I suspect with gold if it's going to bottom. And then what you're hoping for is that it doesn't happen overnight where something is in that big of it doesn't typically do this. It spends some time down at these lower levels, and that's exactly what gold is doing right now, Apple. It's spending some time down in here, and you're getting this kind of equilibrium. It almost reminds me of housing maybe a year ago, where it was starting to reach supply and demand were starting to reach equilibrium. The worst was over, but it hadn't turned up. Now, of course, you're seeing housing turn up. But overall, I think Apple is in the obviously latter stages of the bear market, and hopefully that sub 400 was the low. But again, it may be done going down, but what's going to get the stock going up is, of course, new products, exciting new products. I was talking to somebody at a Verizon store, and they sell everything there, and he was basically pushing Samsung products. He said, and granted, I don't know what the compensation package is there for this gentleman. He could have been paid more by pushing Samsung. I don't know. But essentially, he said, look, Apple invented the iPhone, but all the other ones have done a better job and have kind of passed them. And Apple's technology has pretty much stayed the same, which is true. Apple still doesn't accept flash. They still refuse to go to a bigger phone. They refuse to make a cheaper phone. And yet they're having to discount their phones. I think Best Buy was going to discount the iPhone by another $50 this weekend. So these are all things that are negative. So they have to come out with some type of wow product. We know that the iWatch, earlier this week I tweeted out some research was showing that they're going to postpone that until 2014. So it is about the phone, and there needs to be some type of wow to really get the stock going. But overall, it looks like it may have bottomed. It's just moving sideways. So I actually like Apple, even if it's for a trade. I think if it does break above, let's call it this level right in here, which is probably 460, 470 or so, then I think at least you can go up to the 200-day moving average, get back above $500, and then we'll see from there. Perhaps it pulls back down again, and then off to the races. But again, it's going to be proving to us as investors that they are still innovators, and they're the best, not only innovators, but perfecting that innovation, and that's yet to be determined. One other one here, get asked about sometimes, is Facebook. And I had drawn these 3 arrows a while back, said that it could look like a head and shoulders pattern. This was the shoulder, this was the head, another shoulder, and that's what's ended up happening. Now you're down in this channel again, kind of broke this little support. So we're getting to a point where if it doesn't hold this, which is this kind of bottom end of the channel here it's been in, if it doesn't hold that, then you're going to be looking at significantly lower prices. If it holds right here and bounces, then I think you can have a trade that could take you up again to maybe $30. But I don't think people can still really value this company, and they're having trouble valuing it. That's why the stock was languishing, because there's other companies that are doing some exciting things, and they're just more predictable. When you see a company like Netflix, for example, which has been loved, hated, and now loved again over the past few years, when you see them sign a deal with somebody for more content, that's easy. We understand that. With Facebook, we still don't necessarily understand, where their eventual revenue is going to come from, what the company is going to look like in a few years. So I would still stay away from Facebook. But if it does, maybe have 1 or 2 more down days and comes in here and holds this level here and then bounces, that would be the place to put it. Maybe put your stop right around there, and then again, you've got some limited downside, but you may have a pretty big upside there. And by the way, it has broken again its 200-day moving average, which is only about 2 months old now, because obviously the stock hasn't been around that long. All right, so that's it for this weekend. I hope you have a fun and safe Memorial Day weekend. Thank you very much for joining me. Don't forget Google+, Facebook. We're on iTunes, eggerscapital.com, and again, until proven otherwise, this is still a buy the dip market, and we could have a correction anytime for any reason, but the lower it goes right now, I think these are still buying opportunities. All right, folks, have a wonderful weekend, and we'll talk to you soon.